Hello, everyone, and welcome to topic 17, translation of foreign operations. This is the last topic for advanced financial reporting. We begin with a look at the definition of functional currency. Functional currency is the currency of the primary economic environment in which an entity operates and primarily generates and spends cash. In order to determine what the functional currency ought to be, we need to look at primary factors, secondary factors, and additional factors. These are described in IAS 21. Priority has to be given to primary factors before considering any secondary and additional factors. And that's as per paragraph 12 of IAS 21. The primary factors are described under paragraph 9 of IAS 21. The functional currency, the primary factors indicating the functional currency are the currency that mainly influences sales prices for goods and services. And this is basically the one that will be the currency in which sales prices for its goods and services are denominated and settled. And the currency of the country whose competitive forces and regulations mainly determine the sales prices of its goods and services. The primary factors also are the currency that mainly influences the prices of labor, material, and other costs of providing the goods and services. And this is often the currency in which such costs are denominated and settled. So bottom line, we should first take a look at what is the currency in which an entity sells its goods and the currency in which it incurs labor, material, and other costs of operations. Now, if both the factors indicate one currency, so say it could be the Canadian dollar, well, then the Canadian dollar should be the functional currency. Or if both the factors indicated is some foreign currency, for example, the US dollar, then the US dollar should be seen as a functional currency. However, there can be situations where the entity's sales might be in Canadian dollars, whereas its input costs, the costs of labor, material, etc., are incurred in some other currency. Well, then you have a tie as far as the primary factors are concerned, and you must look at secondary factors. These are described in paragraph 10 of IAS 21, and these basically include the currency in which funds from financing activities are generated, so costs of sources of equity and debt financing, and the currency in which the receipts from operating activities are usually retained. If we still have a mixed conclusion, then we should look at additional factors where these additional factors are applicable in the case of a subsidiary, a branch, an associate, or a joint arrangement. Whether the activities of the foreign operation are carried out as an extension of the reporting entity, rather than being carried out with a significant degree of autonomy. An example of the former extension of the reporting entity is when the foreign operation only sells goods imported from the reporting entity and remits the proceeds to it. An example of a foreign operation that operates with a significant degree of autonomy is when the operation accumulates cash and other monetary items, incurs expenses, generates income, arranges borrowings, all substantially in its local currency. This here would be In addition to looking at the primary and the secondary factors, if we were to evaluate whether a foreign subsidiary or a foreign operation could be a branch, could be an associate or a joint arrangement as well, how much of autonomy does it have? If it has significant autonomy and most of its transactions occur in the foreign or the local currency of where it operates, then the functional currency would likely be that of the foreign country in which it operates. If most of its operations are in Canadian dollars and it sends back the proceeds of sales to Canada, well, then the Canadian dollar will end up being the functional currency. Another factor to consider would be whether the transactions with the reporting entity are a significantly high proportion of the foreign operations activities or not. So keep in mind that when we speak of the reporting entity, we are talking about a Canadian company, right? So if the foreign operation has a significant volume of transactions with the Canadian parent or the Canadian investor, well, then we would argue that this is indicative of the Canadian dollar as being the functional currency. If not, then the local currency would be the functional currency for the foreign operation. Another factor to look at is whether cash flows from the activities of the foreign operation directly affect the cash flows of the reporting entity and are readily available for remittance to it. If so, then we would argue that the foreign operation is fairly integrated with the Canadian reporting entity, and therefore the Canadian dollar should be seen as the functional currency. And the last additional factor to look at is whether cash flows from the activities of the foreign operation are sufficient to service its existing and normally expected debt obligations without funds being made available by the Canadian reporting entity. So if it does, how much does it rely on the Canadian parent company or the Canadian investor company for meeting its debt obligations? If it's extremely reliant, then we would argue that the foreign operation is basically an extension of the Canadian parent, a Canadian investor, and the Canadian dollar should be the functional currency. Based on what the functional currency is, whether the functional currency is the Canadian dollar or not, um, there are two possible translation methods. The presentation currency is the currency in which the parent prepares its financial statements. Um, we are in Canada, so we will assume that the parent company is Canadian, and we will take the Canadian dollar as the presentation currency in all the examples that we'll work through in class. Now, keep in mind that we're looking at translating the financial information of a foreign operation into Canadian dollars. The translation methods depend on what the functional currency is. So the functional currency could be the Canadian dollar, or it could be the foreign currency. And that determination is made by looking at the primary factors, the additional factors, and the secondary factors. So having determined whether the functional currency is the Canadian dollar or the foreign currency, then we would conclude that the subsidiary is either integrated with the Canadian parent, and hence the Canadian dollar is the functional currency, or it is self-sustaining, autonomous, and hence the foreign currency should be seen as the functional currency. If the Canadian dollar is the functional currency, i.e. we have an integrated foreign operation, then we use the temporal method, also known as the functional currency method to translate its financial information. If, on the other hand, the subsidiary is seen to be self-sustaining, then we use the current rate method, also called the presentation currency translation method. The translation gain or loss is calculated using changes in the net monetary position in the case of an integrated subsidiary, i.e., when we are using the temporal method. And when we use the current rate method, we calculate the translation gain or loss using changes in net asset. These two calculations are significantly different. The translation gain or loss calculated is reported in net income under the temporal method in comparison to other comprehensive income for the current rate method. Income statement items are translated using historical rates. Average rates may be used for evenly occurring transactions under the temporal method. We use average rates for all items under the current rate method. For the balance sheet, monetary items are translated using closing rate under both the methods. And non-monetary items are translated using historical rates under the temporal method, closing rate under the current rate method. Common shares are translated using the historical rate on the date of acquisition under both methods. A look at monetary versus non-monetary items. The essential feature of a monetary item is a right to receive or an obligation to deliver a fixed or determinable number of units of currency. Examples include pensions and other employee benefits to be paid in cash, provisions that are to be settled in cash, lease liabilities, cash dividends that are recognized as a liability. Similarly, a contract to receive or deliver a variable number of the entity's own equity instruments or a variable amount of assets in which the fair value to be received or delivered equals a fixed or determinable number of units of currency is a monetary item. So bottom line, the dollar value should be fixed. Conversely, an essential feature of a non-monetary item is the absence of a right to receive or an obligation to deliver a fixed or determinable number of units of currency. Examples would include amounts that are prepaid for goods and services. So you don't have anything to be paid again, or you won't be getting cash back. You will be receiving goods and services in return. Goodwill, intangible inventory, assets, inventories, property, plant, and equipment, right of use assets, provisions that are to be settled by the delivery of a non-monetary asset. So basically, a good way to think about it is that for monetary assets, you will want to include cash and any kind of receivable. So accounts receivable, notes receivable. And monetary liabilities will be basically all liabilities that are to be paid for in cash. Let's now look at the functional currency translation method in some detail. First, we want to look at the calculation of the translation gain or loss. Now, the translation gain or loss under the FCT method, the temporal method, is based on changes in net monetary position. So we need to begin with the beginning net monetary position, which is basically the difference between the beginning monetary assets and the beginning monetary liabilities. These are to be translated using the exchange rate at the beginning of the fiscal year. Changes in the net monetary position, these happen due to sales. So sales can be either made for cash or on credit, either way, the either the cash balance goes up, which increases monetary position, or accounts receivable increase, um, which also brings about an increase to the net monetary position. So sales bring about an increase in the net monetary position. Um, Normally, uh, because we are talking about translating the numbers for a foreign subsidiary at a single point in time, and there must have been literally hundreds of sales transactions during the year, it may not be convenient to translate all of them using historical rates. So there, a more compromise can be achieved by using an average rate to translate the sales value. Now, a proviso here is that the exchange rates should not have been too volatile during the year. If they were, then we cannot use an average rate, then we'd have to do something else. That unfortunately is beyond the scope of what we are looking to cover here. So in most examples that we work through, we will be translating sales using the average rate. Purchases of inventory will decrease our net monetary position. Now, again, here we can use the average rate if inventory purchases occur evenly throughout the year. Sometimes in problems, you may be given specific purchase dates for when inventory purchases occurred. In that case, we would need to use historical rates. It's the same issue with sales. We would prefer to use historical rates. It's just that the subsidiary would likely have a lot of sales transactions, so it may not be economical on our part to try to translate each sale using the historical rate for the date on which that sales transaction took place. Um, so we use an average rate in U. Similarly, for purchases, we use the average rate if purchases occurred fairly evenly throughout the year. Operating expenses that are incurred in cash, so you need to exclude non-cash items such as depreciation from there, bring about a decrease to the net monetary position. These operating expenses typically occur evenly over the year. We're talking about payment for rent, salaries, etc. Those are fairly stable across the year. So it makes sense to use an average rate to translate these numbers. Interest expense will always be translated using an average rate because interest accrues evenly with passage of time. Income tax expense, now this can sometimes cause a little bit of confusion. We may calculate income tax expense at the end of the year once we have determined the income before tax, but the income itself has been earned throughout the year. So the income tax expense relates to income that has been earned throughout the year. This is why we use an average rate and not the um, closing rate for when the actual income tax expense might be calculated. Sometimes students end up making mistakes using the wrong rate because they think that the income tax expense is calculated at the end of the year, and hence the closing rate should be used. Use the average rate. Purchase of a non-current asset such as land, equipment, building, so on, will decrease the net monetary position because you would either have now an exception where you have a non-monetary transaction. So you can have a situation where you have a purchase of land by issuing common shares. Well, that does not have an impact on the monetary position at all. But most cases, purchase of assets have to be paid for either with cash or you incur some kind of a liability that will be settled later on by payment of cash. So most cases, purchases of non-current assets will decrease net monetary position. we must use the historical rate for the date on which the asset purchased. Sale of a non-current asset will increase net monetary position. You want to use the historical rate for when the asset had originally been acquired. Okay, not when the asset was sold, but rather when the asset was acquired. The difference between the asset's carrying amount and what it was sold for gets captured as a gain or loss. So we want to make sure that we are not uh, conflating the issue. So if there was a sale of a non-current asset, we want to use the historical rate for when the asset was acquired. Okay, the resulting gain or loss will be captured as a translation amount. Dividends reduce net monetary position, and dividends are to be translated using the historical rate for when the dividends were declared. Sometimes you're given information on when the dividend is declared, and then later when the dividends is paid. Pick the rate for when the dividends were declared. Because the moment the dividends are declared, a dividend payable liability is created, and that results in the net monetary position decreasing. Adding up the changes to the net monetary position to the beginning monetary assets, we get the ending net monetary position. Now, that ending net monetary position, um, using the translated amounts, gives us a calculated number for the ending net monetary position. We compare that calculated amount to the actual ending net monetary position, which is translated using the closing rate, the rate at the end of the fiscal year. Any difference between the actual ending net monetary position and the calculated net monetary position is the translation gain or loss. If the actual ending net monetary position is higher than the calculated amount, we have a translation gain. If the actual ending net monetary position is less than the calculated net monetary position, that would be a loss. So make sure that you specify whether it's a translation gain or a translation loss. And this amount is reported in net income. Something that you want to keep in mind is that historical rates can never predate the date of acquisition by the parent company. So when we are using historical rates, and this is specifically applicable to the case of sale of non-current assets. So you could have a non-current asset that had existed when the parent acquired the subsidiary. It had been purchased at a date before the date of acquisition by the parent company. You need to make sure that your historical rate is not from a date that is earlier than the date of acquisition. All right, the earliest we can go in time is the date of acquisition by the. So what exchange rates do we use? For the income statement, sales are translated using the average rate. Cost of goods sold is a calculated amount. And the calculation involves taking the beginning inventory, for which we want to use the historical rate, add the cost of goods purchased, use historical rates or average if they occurred evenly over the year, and subtract the ending inventory, which is translated using the historical rate for when the ending inventory was purchased. So beginning inventory, add purchases minus the ending inventory gives us cost of goods sold. Operating expenses with the exclusion of depreciation, are translated using the average rate. Depreciation is calculated, and for depreciation, we want to use historical rates for when the asset was acquired. Do keep in mind that historical rates can never predate the date of acquisition by the parent. Interest expense is translated using the average rate. Income tax expense is translated using the average rate as well. We would include the translation gain or loss that was calculated in the first step to give us the total translated net income. For the balance sheet, monetary assets are translated using the closing rate. Non-monetary assets are translated using historical rates for when those specific assets were acquired. Not the monetary liabilities are translated using the closing rate. Rare occurrence, but if there are any non-monetary liabilities in this course, it's very unlikely you will come across any. We must use the historical rate to translate them. Common shares are translated using the historical rate at the date of acquisition. Retained earnings, the amount is to be calculated. So beginning translated retained earnings, add the net income calculated in the income statement, minus the dividends translated using the rate for when the dividends are declared. If there is accumulated other comprehensive income, then that will be a calculated amount. Taking a look at the presentation currency translation method, this is the current rate method. The translation gain or loss calculation is based on changes in net assets. So net assets are common shares plus retained earnings. The beginning net assets are translated using the beginning rate. Changes to the net assets during the year happen with net income. Net income makes net assets increase. You use the average rate for net income. Dividends make net assets go down. Use the exchange rate for when the dividends were declared. This will give us the ending net assets amount calculated. We compare this ending net assets to the actual amount translated using the closing rate. And once again, any difference between the actual ending net assets and the calculated ending net assets is the translation gain or loss, which is reported as other comprehensive income. The exchange rates to use for the income statement, every line item is translated using the average rate. So basically, net income gets translated using the average rate. And then you have to keep in mind that we must include other comprehensive income. So in the case of PCT, we actually end up preparing a statement of comprehensive income because other comprehensive income will be in play. For the balance sheet, all the assets, whether they are monetary or non-monetary, and all the liabilities are translated using closing rate. Common shares are translated using historical rate on the date of acquisition. Retained earnings and accumulated other comprehensive income are translated amounts which have to be computed using the beginning balance and the changes that took place during the year. Once again, cautionary note, when using historical rates, you can never use a rate that is from a date earlier than the date of acquisition of the subsidiary by the parent company. This is it for this lecture video. In class, we will take a look at examples that will help illustrate both the methods. So I look forward to seeing you in class. Thank you for watching, and thank you for a great semester. Best wishes.